Your job, if you have a job right now, your job is the risk, not real estate. Your job is the risk, regardless of the market. Get creative, get comfortable with creative, get your skill set raised with creative, and then be able to bop and weave no matter what it does. So we teach investors who want to tack on creative real estate and people brand new, mostly coming out of the corporate world and wanting to get into real estate. And we teach them what? We teach them how to buy without signing on bank loans ever, without taking out loans in general, even if they're non-recourse, and without using huge amounts of your own money. I'll never say no money, but very little of your own money. How do we do that? 3 ways.
Hey there, and welcome to another episode of the Jack Bosch Show, where we talk about all things real estate, finance, creative investing, wealth building. And today's guest fits right into the bucket of creative real estate investing. So we're going to talk about how to creatively do deals, how to get into them, exit them, how to not use your own money, etc., etc. So my guest is Chris Prefontaine. And so, Chris, how are you doing today?
I am great. Good to see you again, Jack.
Good to see you too. Yes, you have been on our show probably at least a year and a half, if not 2 years ago. So let's just jump right in. How is business these days? What you're doing? What has you most excited right now? What is your favorite thing to do right now in the real estate space?
Yeah, business is great because whenever there's sort of uncertainty or any turmoil whatsoever, it drives the demand for what we do in the creative world. So right now, most excited about the deals that are going on. We're in 80 markets now with our coaching because we revenue share with our students, our members. So it's really cool to see. It's sort of a microcosm of society, if you will. We get to see all these different markets. It kind of puts a squash to those people, Jack, that ask us all the time, you and I both, how's the market or what's the market going to do? There's all different pockets in the market, right? So it's neat to see that. Florida, for example, is just getting beat up now. Other markets are still booming. That opens major doorways for us. We still are seeing a large amount of loans, obviously, statistically in the 2, 3, 4, 5% range, and we can buy those with the loans in place. So just some really cool things happening right now.
All right. So explain for those who haven't gone back and listened to like 75 or 80 or 100 different episodes of our podcast before. So to get to the one that we have done before. Explain to our audience again, what is your core business model? Of course, understanding that it varies in different markets based on different conditions, but generally speaking, what is your core business model?
So we teach investors who want to tack on creative real estate and people brand new, mostly coming out of the corporate world and wanting to get into real estate. And we teach them what? We teach them how to buy without signing on bank loans ever, without taking out loans in general, even if they're non-recourse, and without using huge amounts of your own money. I'll never say no money, but very little of your own money. How do we do that? 3 ways. Owner financing. We niche down owner financing to free and clear sellers, no mortgages. That's about 1/3 of the properties in the United States. Second is subject to existing financing. That's why I mentioned the nice low rates that still exist from those loans that were, out there at the 2, 3, 4 years ago. And then the third way, we don't actually buy like the first 2 ways, but we control, and that's lease purchase. So you can control just an enormous amount of real estate with literally $10 per property. That's how our agreements are built.
All right. Okay. So I actually just looked it up. The last time you were on our show was actually, I think you were twice already in our show. Last time was in 2023 in August. So that's exactly what episode that was, but it was on August 30th, 2023. And we talked about some of the similar things, but it's a good time update right now, because with you being in so many different markets with your students, you can really tell us what works today and what doesn't work today. So let's jump right into that. So obviously 3 things: seller financing. What was the second one?
Sub 2.
Subject 2, and the third one was which was the first one we mentioned, lease purchase. Okay, so in the current market, and again, there's no such thing like a current market, but let's segment the market. In the market where prices are going down right now, what are you applying there? What are you using there mostly?
Yeah, I'll use direct examples. So we have a gentleman, Jeff. We have several in Florida, but Jeff's quite active. And I told Jeff, look, you can handpick which properties you want. It's not, can I go find properties? It's, once you do that, make sure owner financing or sub 2, you're buying them. And on the owner financing, you're not pinning yourself to a short term because you don't know what the market's going to do. So I like bare minimum 5 years, love 10 years, right? Because I don't care in 10 years, the market's going to be fine. So it can bop and weave all we want. It's a nice recession hedge to have a nice long term. That's the main thing I do in a kind of a sinking market, if you will.
Okay. So in other words, you do then, do you say seller financing in that case?
Yeah. So we seek out
Financing, lower interest rate, longer terms, so that you can wait out the time that it takes. Now, once you have seller financing on a deal like that, what is an interest rate that you see your students get these days?
Okay, so here's the punchline. 99% of our deals are done with zero interest in the residential space, in the single family space. So we're making payments to the seller, monthly payments going directly against principal. As long as it's under $1 million and it's their primary, we don't have to have imputed interest at all.
Okay. Now, why would a seller do that right now? Like if they have a free and clear property, why not just put the property on the market and sell it?
Well, sometimes it's I'm going to answer Florida in a sinking market to your earlier question.
Yeah. Let's stay with the sinking market in Florida, which, by the way, guys, there's certain markets. If you're new here, if you're new to real estate, I've been in real estate for 24 years now. There are certain markets in the US that react a little bit more schizophrenic, or not schizophrenic, more crazy. They have bigger swings than other markets. Like if you look at Omaha, Nebraska, when the 2008, 9, 10 crash came, Omaha, Nebraska did absolutely nothing. It dropped by less than 1% of market value, not even. Now, when the big boom before in 2005, 6, 7 happened, Omaha, Nebraska did exactly nothing. And since then, Omaha, Nebraska has done almost nothing. It's gone up by like 2 or 3% per year, and very stable market that's not shaken. In the same time, if you look at Arizona, California, and Florida, they have gone a freaking roller coaster since then, right? They've gone way exuberantly up, way exuberantly low. And what that means is that in times where the market is exuberantly, if I want to say that, if that's even the word, negative affected, and if it goes down, you can take advantage of those swings because the market goes overboard. And that's really a cool kind of strategy here from both you being this buyer in the seller financing market, but it's actually also a protection if I see it from the seller, isn't it? The seller gets to lock in a little bit of a better price than potentially by having it on the market for another 6 months.
Well, that's the key with respect to your specific niche question of market going down and pricing, because they're panicky. Now, the press is helping us, right? The media is helping us. They're screaming worse than it is, but it is going down a bit. So they're going to lock that in. And picture from an investor standpoint, the hedge we have, forget the longer term, just the fact that we're doing principal only, that is hammering down principal. And we're covering that with a buyer. So, but it's nice to know that that's getting hammered down, and the longer the term, the better.
Yeah, and of course, the longer the term, that's something that's desirable for the seller too in this market, because the seller doesn't want you to have a 2-year loan or something like that. And then, well, perhaps they want a 2-year loan or balloon, but they feel the risk that in 2 years, if that house is worth less, you're going to back out and you're going to just live stranded with a house that's now worth way less than it before in his mind. And so the seller wants a longer term because they're like getting longer cash flow. Of course, at some point of time, they want to be cashed out, but so it's a balance there. But you also want that because I assume in your paperwork, you have the ability to cash out the seller at any time too.
Yeah, there's no prepayment. Of course, I'll give you an example. I had a commercial building I bought, back in 18, and I had a 20-year term. But I cashed it out in 23 just because it was great timing to do so. There's no prepay unless they negotiate that in. But I would tell you to try to avoid that, obviously.
Yeah, of course. And commercial, that's possible. In residential, I don't even think it's legal even to do
in many areas. Yeah,
many areas well, at least institutional lenders can't really in residential can't really do prepayment penalties unless you're using it for commercial purposes. It's like your 27th rental. It's a different story than if you buy one right now. Right. Very cool. Yeah, so this makes sense. And now again, let's stay in that market, and then we shift to different markets and different strategies. What is the preferred way of finding those deals? Like, I got a friend here who is very well known in the coaching industry, who has been in the coaching industry for 40 years. He does somewhat a similar model, but he basically in these markets he goes straight on the MLS and he makes like 30% below market offers or below asking price offers, and he gets them accepted. Do you guys do similar things, or what do you typically do to get those deals?
We don't. We're usually doing off-market properties. Off-market would be no particular priority order, expired listings for sale by owner, both hot right now in Florida. They're plentiful. For rent by owner, hot in Florida. They're getting tired, the landlords.
Yeah.
And then if that's not producing enough leads, which frankly in Florida it is right now, then we'd go to niche lists like free and clear, out-of-state owners. That's a great one. Free and clear, out-of-state. They're probably keep panicking if they have a second home down there, right? With between the floods and the market. That's a nice one. We recently did a mailing there for free and clear, out-of-state, and tax delinquent, believe it or not. So there's a list that popped up for that. So there's all kinds of niche lists you can buy in the United States anyway. Canada gets pretty restricted, but in the United States, you could buy a list of anything.
Yeah, that's true. That is definitely true. You can buy everything. When I speak, as my audience knows, I'm from Germany originally. When I speak to German audience, occasionally I get invited on a podcast or I get asked to speak in Germany or so. The very first thing that I tell people is that there's no data privacy in the United States. This is like, and that is like shocking to the Europeans because in Europe, everything is data privacy. Yeah. Like I know, it's like I keep bringing that example, but have you ever gone to Europe and looked for restaurants? I assume you have been to Europe, but if you are, I'm a foodie, so I love finding good restaurants. So the first time I did this a bunch of years ago, they changed the law. And then afterwards, I looked at like whatever, TripAdvisor and different kind of websites and looked for restaurants. And I look at the pictures. I want to make sure that it's not just highly rated, but it doesn't look like a crap hole, that it actually looks like nice and so on and doesn't look super touristy. So I look at the pictures, and every picture of every restaurant, the restaurant is empty. It's like, why do I want to go to an empty restaurant? Yeah. And I realized it's empty because privacy rules are so much that you can't even take pictures of people and put them on your website of a full restaurant. You would literally have to get written authorization from every single guest to be able to put that picture onto a website, which obviously is impossible if you have like 75 guests in the room and we take 7 pictures, and each time there's different sets of guests because some come, some go. It's like impossible. So as a result, they basically take the pictures when the restaurant is closed before they open and have a bunch of empty pictures. And that extends into everything over there. In the US is the exact opposite. You can buy a list of absolutely everything. So what is your favorite list right now to go after? I mean, you mentioned them, but out of all of those, which one is your number one?
I still love the free and clear.
Free and clear, yeah.
Plus I'm searching for the low interest rate ones. Those are fun, but I still like, if you ask me in any market, free and clear and out of state is fun.
And that is simply, and I agree with you, because in land, that's all we're dealing with. Because if they have had it long enough in the family, free and clear typically means that most people don't own free and clear because they bought it cash. Most people own free and clear because they bought it for $100,000 40 years ago, and now it's worth $400,000, and they have paid it off 20 years ago. And now if you offer them $250, they're like, hey, I made money on my deal, when it's really worth 400 or so.
And they don't want to get whacked in taxes necessarily up front, so they are more prone to push it out over time. Again, so this all meshes with what you're saying.
Yeah, that's true. That's a very good point. They understand the taxation issue, that if they sell it once, they get hit with one big tax bill, but if they get little by little, perhaps they have some losses somewhere else, they can offset that and they can not pay the taxes. Yeah.
And maybe even they're in they know that they're going to be in a lower tax bracket down the road. So there's all kinds of nuances that makes that work.
That's true. Like, yeah, when we connect with some of the people that we buy our land from, we sometimes send them a letter or send them an attachment to the letter that says, why is this offer so low? And then a second attachment that tells them like, hey, did you know that if you sell it to us at a loss, you can actually take that loss as a write-off, and you won't believe how many people do that. Now, That's not necessarily what you're dealing with, but it's the same principle that people are looking at it like, well, the tax impact plays a role in the decision. Certainly. And we as investors, particularly if you're a beginning investor, are not always giving that its proper spot on the hierarchy. You're like, yeah, whatever. They just want to maximize the money because you want to maximize the money. They might be looking at different kind of factors there.
Yep, spot on.
Yeah, very cool. Let's move into another market. Which markets are still booming right now, or it's still growing at least?
Well, a lot of the cities, like I've got a student that is in Canada but works the market in Washington State. She works a few of those markets, but the closer you are to a city that didn't get whacked, then that's still a hot market. I mean, my area right here, I live on an island with 3 towns. It's a hot market still. It's
Where do you live?
very difficult. I'm in Newport, Rhode Island. So there's
Okay.
it's 3 towns. It's called Aquidneck Island. My brother's trying to relocate here from Delaware. He cannot get a house. Like so far, he can't get a house in his price range. So it's still hot, because you're near the water.
Yeah, no, that makes sense. Well, okay. So what's your strategy in those markets?
I still rely on the expireds because I don't care how good the market is. They might be less, but they're good. They're good because they didn't sell for whatever reason, right? It could be price, but whatever reason. Secondly, the free and cloud of state, mainly because the media is screaming at them that the market's going to, fall through the ceiling, through the floor, and they are panicky if they have a second property. We're getting a lot of good deals on those out of state owners because they just don't know what to do. They're not sure who's right.
Okay, so and in those scenarios, play me like walk me through a typical deal. Like how does that turn out? What's kind of the numbers and so on?
I'll give you a small one because I can give it, like a lot of people do. I can give this big fluffy one, but let me give you a very modest one. We recently bought one for 183. It was free and clear. It was on the market with a realtor for about 2.25. I'll use round numbers. And how we came to 183 with the seller was we said, look, it didn't sell, but if it did, you got to pay a fee. You got to take a certain percentage of your list price. You're probably going to get. You didn't, but if you did, what do you think you would have got? He said 183. Okay, we'll pay you 183. We will do no money down, and we'll do $923 a month principal only. He was relocating to South Carolina and was panicky because it didn't sell and just wanted closure. He said, hey, can you come do that owner financing thing you talked to me about? And we tied that up literally on his front porch, simple conversation. The attorneys closed it remotely. And that little deal we bought for 183 due to our 3 payday system profited us over 6 years, 128 grand on a 183 house. Pretty cool deal because of the way we structure the 3 paydays, how we exit.
And let's talk about that. How do you structure those?
By and large, we can get more advanced on it maybe a different time, but by and large, we exit on rent to own. And our goal, unlike a lot of people who teach this incorrectly, is to get the buyer cashed out. And so that
the exit on rent to own. So in other words, you get it you get it via a seller financing deal, or a lease purchase, or a I'm not my sharpest today, I guess.
Sub two.
Or a subject to, of course. And subject to in each 3 of these, in all 3, well, in 2 out of 3, you own them. In lease to own, you kind of become the tenant, but with the right to buy it at any time, and also the right to sublease, right?
Correct.
And
correct.
because then but either way, you have control of the properties, and then you turn around and you like to exit them with lease to own.
Yep.
Right. So there's literally situations where you, the lease to owner, basically you agree with somebody that you're going to lease it. With a part of the lease goes towards purchase price, or is it
When we buy, yes. When we sell, no.
Okay, very interesting, very interesting. So let's break that apart a little bit. Again, we have some beginning investors here, but let's break down what does lease to own mean in the first place.
Sure. All it means, if I'm talking to a seller, is I'm going to agree, no title transfers. I'm going to agree to a certain amount of equity. Let's use numbers. Your house is worth 300, didn't sell. I say, I'll give you 300, you owe 200. I'm not agreeing on price, and I'll tell you why in a minute. I'm agreeing on protecting the 100 grand equity. So I want to be for 36 months, Mr. Seller. I'm going to pay off the underlying loan that remains, and I'm going to give you your 100 because the underlying loan is going to be less than, right, in 3 years.
Yeah.
So I install my tenant buyer number. Keep in mind, these are buyers that get vetted strictly, at least with our system, and they have a mortgage ready plan. So we know if they stay on track and don't have a life event, when they're going to cash out within reason. So then they take over. I'm paying the underlying mortgage, but they're paying me something higher. That's one of our paydays. And then at the end, when we cash out, we're accumulating all that principal pay down and any markup.
All right, so let's go back. I fully understand what you're saying, but perhaps not everyone does. So let's go back to the acquisition side. You go to, in this case, it's not really an acquisition, but you go to the sellers. You say like, I'm gonna agree to $300,000 on a house, and I'm gonna go I'm going to go pay you. I'm going to rent the house from you with a right to buy it at any time. And I'm going to pay you X amount per dollars per month, whatever that is, $1,500 or something like that, or $1,000 a month, enough to pay the mortgage.
Yep. We usually pay the mortgage direct typically.
And that's the next point. Yes. So you pay the mortgage direct. You don't leave it up to the seller, because otherwise they might go on vacation with that money and that property goes delinquent, and boom, all of a sudden there's a foreclosure at hand. So you agree that you make a payment, you pay the mortgage directly, and perhaps a little bit goes into his pocket, depending on what you negotiate. Yeah, that's his money, so he gets a little bit rent. Great. So then you have the right to live in the property, or you have also the right to actually release it. So you now go, obviously you won't live in there unless you do this just for yourself. But then as an income strategy, you now release it, but you don't just get a tenant. You do the exact same thing. You find yourself a tenant that wants to buy the property, and you pre-qualify that person properly, and you know that based on their income and based on their credit and based on some of the things, they probably are going to be able to execute on that and buy that property in, let's say, 36 months.
Right.
So now they make payments to you, which those payments are obviously higher, and they do not reduce the equity here, right?
Correct.
So they're basically just rent payments. They just rent it. So
that's their incentive to get their loan. Yeah.
Yes. Let's say the $1,500 that you pay to the seller, you negotiate that all of that goes towards the $300,000 that you agreed to buy, to the $300,000 that you agreed to do that, or that $1,000 goes to pay the mortgage down and the $500 goes to him, but whatever, that $500 gets deducted from the purchase price later on, right?
Yeah. Yep.
All right. So therefore, with time, the longer you do this, you actually don't pay him $300,000. If just let's pick a number, $600 or $500 a month goes to them as deduction. After 1 year, you only owe them $294,000. After 2 years, it's $286,000. Yeah. Right, et cetera, et cetera, et cetera. So that's good. So that builds equity for you. And then the other side, when they pay you, let's say $2,000 in rent a month, you just get to keep the $2,000, and that does not reduce their purchase price.
Yeah, correct. And so it's pretty neat when you think about when you do that on a free and clear, and it's all principal, you're getting major principal benefits. Yeah.
Yeah, absolutely.
So that is 100%. Paydays, Jack. I mean, you have the big distinction is these are buyers who need time versus renters who someday maybe have a dream to buy a house, right? So they have a down payment, payday 1, the monthly spread, payday 2, the cash out, payday 3. In our community, just to give you a sense of the size, those range from a high of $350,000 per deal all the way down to $45,000, depending on price and structure. But those are sizable deals. Those aren't small deals for most people.
No, absolutely. And again, if like when somebody said like, well, why would somebody do that? Because you put it right on it. Can you expand on that a little bit more? Yeah. It's like, why somebody's a buyer and needs time? What makes them need time?
Okay, buyers needing time, 2 main categories that we like. There's a lot of other reasons, right? But buyer needs time because there's a major boom now since COVID, up and up and up every year, of people leaving corporate, record numbers, and starting their own business. Most of them don't know. They walk into a bank, literally get financing. They have 50 grand, whatever down payment, and they realize, nope, you're not financeable. You need 2 years of what the bank calls seasoning. And I heard that's getting worse, creeping up, depending on who they are. So 2 years of seasoning, what do they need now? They're going to miss the market if it's a growing market. So they're going to want to lock in through our rent-to-own program and get mortgage ready in 2 years. Now, those are better than the next category I'll give you, because that buyer I just described has cash and has good credit. The other category is, okay, I had a life event, divorce, death, COVID, whatever, so I got a credit ding. And it was legitimate. I haven't had bad credit for 40 years. I had a legitimate thing that I can track. And now we're going to put them through the credit enhancement program and get them mortgage ready. Usually doesn't take that long, anywhere from 6 to 24 months. So those are the 2 major categories. Now, what causes the credit can be all kinds of life events, but those are the 2 major categories of buyers.
And there's plenty of them too. I mean, in our rental properties, we underwrite a lot of people, and there is a bunch of people that during COVID had major hardships and lost they weren't evicted because COVID didn't allow for that, but they had major hardships, got sick, lost their jobs and things like that. And eventually, once they were allowed to evict again, they had to leave. And so they have a ding on their record, but it wasn't because they necessarily didn't want to pay. It was because they can show proof and everything that they got like ill and sick and had hardships in the family and things like that. And now these things like are older, usually, but they're having a hard time getting into even a rental apartment. We're giving them a hard time too, and we're actually checking on all these different things. But there's cases that we have come across where somebody legitimately has rebuilt their life, legitimately has like a clean record for 3 years, legitimately, or for 2 years, legitimately has built in a really good income, but still has that bad thing on there that still sits there for probably another couple of years. That would be a great candidate for this. And obviously, in our case, we rent to them, but
I'll give you a super good example. There's many, but like there's one recently, a mason had driven by, a single mason, just a bricklayer, drove by this house every day. Realtor sign was out. I get it. After the realtor couldn't sell it for a year, I get a call from my sign within days. I think it was 5 days. And I said, how'd you find it? He said, I drive by here every day. I said, why didn't you call the realtor sign? He said, I'm not qualified. I got beat up during the last crash and he had a construction company. Now, fast forward, he's cashed that house out. He's built a monster business. He's doing phenomenally well. So you give someone like that a chance. For the deserved buyer, it's a great program.
Yeah, absolutely. Very cool. So again, let's go into the market conditions. So in markets where prices are still going up, why wouldn't seller financing be the preferred option? Well, it doesn't really matter what option you use there, because which strategy you use there. But which one do you see most working in, depending on different market conditions?
Well, if you said, Chris, pick one that was the most, like, let's say, safest or diverse, I would still bobble between the owner financing because of the principal pay down, right? That's a hedge. And I would go to the sub 2 because there's no term on a sub 2. There's no such thing as a balloon. I'm going to own that house. It's my choice. So I like that flexibility for sure.
Yeah, that makes sense. But just from a point of view of like, what do you see working in the market? Like, I can tell that I can say, like, you don't necessarily want to be in charge of a mortgage in a severely declining market, because very quickly you might be under market, and you might be underwater, and then you have to hold out for that for quite a while for it to come back. The seller financing is kind of the easier thing, particularly if all of it goes to equity. So I can probably see in a declining market you getting to many more people to the expired listings, and therefore and expired listings are usually, I guess, expired because they can't go further down because they're getting to the limit of what they have in equity. Somebody who's free and clear can always go further down until it finally sells. But so I can see those kind of subject twos and things like that, and seller financings also being very popular in a declining market. In a stable and increasing market, what is the easiest strategy to get a yes to on the market, or what do you find more available to you? Which of these strategies?
Well, for the investor, the easiest, let me say, sell, even though it's not selling, you're solving, but the easiest communication for a new investor is the lease purchase, because you're not talking about a deed transferring. So when I was newer coming out of the crash, maybe some of it was confidence, maybe some was coming out of the crash, I did a lot of lease purchase. Like, that's how I started doing things, because it was a simple sell. Not too many people said no. And it was a flat, slightly rising market, just like you just described. That's what I came back in. Yeah. So the lease purchase is easiest.
Okay, very good. And so there we have it. So cool. So now, with that said, so how does somebody get a hold of you? How does somebody learn more about what you do?
Couple things, Jack. If you remember, we like to give our book out to your tribe, and it's free. It's not one of those book offers that says free and then you put in $10 for shipping. It's free. We'll ship it to you. Just go to wickedsmartbooks.com, and we will honor that and get those books out to you. Just give us a week or so. You might get some goodies in there as well. And then if you want to, I have a workshop. Everything we're talking about and batting around, kind of an A to Z workshop. It's pre-done. It's pre-recorded. You can watch it at your leisure. Just go to smartrealestatecoach.com untold.com/masters class. Everything's free.
Okay. Wonderful. Very cool. So smartrealestatecoach.com/masters class. All right. We'll put it into the show notes, of course.
Awesome.
Very cool. So what else are you interested? What are you excited about right now? What do you see in the market? Do you predict? Let's talk about the market. Since you have a little bit of a bigger picture than most people, since you're operating with your students in multiple markets, what do you see? If you have a crystal ball, what do you see in the future coming?
Yeah, let me do a prelude to that, a disclosure. If you and I even remotely knew, we wouldn't be on the podcast. We'd be in some island somewhere, right? But my thought is that with all the turmoil, we're going to stay kind of like in this holding pattern that we're in, except for some of those markets that are going south. But let me say this to the listener: be comfortable with learning creative so that you don't care, or you don't care as much what the market's doing. That's more important than what's it going to do, because none of us know. Get creative, get comfortable with creative, get your skill set raised with creative, and then be able to bop and weave no matter what it does. My wife, I've been married 39 years this summer, Jack, and my wife always says, well, how's this going to affect you? And how's this rate going to? I said, I don't care. As long as you know how to pivot with deals, you don't care. That's the best spot to be in.
You said the best word, pivot. Like in real estate, tell us to our land investors, the land market is not the same today than it was 2 years ago, than it was 5 years ago, right? And it's not worse today. It's just different today.
Yeah.
Right. So temporarily, the below $20,000 properties the market has broken away of those, and nobody, the demand for them is just simply not there. Well, as soon as the economy starts coming back up, whenever that may be, those properties are going to be in high demand again. But right now they're not. And guess what? Right in 2010, 11, 12, they were not. And guess what? In 2001, 2, 3, they were not. And so this is a cyclical kind of thing. So during certain times, you got to pivot to larger properties, pivot to different kind of properties, pivot to different marketing strategies, pivot to different entry and exit strategies. And that's the beauty of real estate. It's not, the times are over, particularly now with AI coming and taking everything over. The times are over where anyone in any profession can just simply say, you know what, I'm done. I learned this. I'm going to just ride this thing for the rest of my life.
Yeah.
Like used to be like you're a locomotive driver, like you work for the train companies and you're the driver of the train, right? That was be say, well, who knows? A robot can run that thing probably safer. It doesn't fall asleep.
Yeah.
Right? Doesn't fall asleep and miss the signal. Right? So there is no job that is going to be unaffected by AI, by the conversions of AI, batteries, energy, all these different things, robotics, and those kind of things. So, but people still need a place to live. So how we go about what we do, how the market price is going to go in those things is always going to change based on different kind of things. But if you're if you're learning, and if you're creative, and if you learn new strategies to apply to new different worlds, you can always pivot and you will always be fine. So I love that attitude of yours.
That's why I say over and over and over, and I'll say it as we get to the end here, and that is your job. If you have a JOB right now, your job is the risk, not real estate. Your job is the risk, regardless of the market.
I like that. Your job is the risk, and your complacency is the risk.
Yeah.
The moment you become complacent, my dad could afford to be complacent because he was a middle school teacher for 41 years. He was a great teacher, like he really cared about it. But I mean, there's nothing you teach in music and German that is ever going to change.
Yeah.
You're going to continue to forever to teach Mozart and things and all this kind of stuff and then music history, and you're ever going to teach grammar and sentence structure and creative writing and stuff like that. He learned that once and he was able to apply that for 41 years. I would die if I would have to do that. That's like not my life. But he thrived in it and he loved it, and that's what he always wanted to do. But even that is changing. New methods, new thing, AI thing. There's not a role in this world. If you're complacent, you are on the street 5 to 10 years from now. You gotta start removing that from your vocabulary and your mindset and start getting creative and learn everything you can about if you want to be in real estate, about creative real estate investing, because that is going to continue to be the future.
100% agree.
All right, Chris. Well, thank you for being on the show with us. I appreciate you. You guys understand there's a why Chris has been here for the third time because I love his creative spirit. I love his fast thinking and approach to things. And plus, he's operating in so many different markets that he has a really good picture of what works and what doesn't work. And as we can tell, different things work in different markets, and it's your job to adjust to the market. Don't expect the market to adjust for you. All right, with that said, thank you for being on the show.
Thank you.
All right, guys. And as always, make sure you guys hit that subscribe button. If you watch it on YouTube, hit that subscribe button there. Hit that notification button. If you watch it on iTunes, please go and give us one of these 5-star reviews. If you watch it on any other platform, do whatever that platform provides to give us a review. Help us go up in the rankings and helps more people to see what we talk about here. That's it. Thank you very much. That's a wrap. See you in the next show. Bye-bye.